Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business. Today we're diving into Williams-Sonoma's latest financial report, and let's just say the home goods giant is navigating some interesting currents. So what's the big story here? Williams-Sonoma, the company behind Pottery Barn, West Elm, and the Williams-Sonoma brand itself, just dropped their quarterly earnings. It's a look at how they're doing in the second quarter of 2025, comparing it to the same time last year. Let's start with the top line, the money coming in the door, before anything else. For the 3 months ending August 3rd, 2025, Williams-Sonoma pulled in $1.83 billion in net revenues. That's up from $1.78 billion in the same period last year. That growth, about 2.7%, might not sound huge, but it's good news in a sometimes tricky retail climate. Now, what happens after they pay for the stuff they sold? That's gross profit. This is a really important number because it shows how efficiently they're managing their direct costs. Williams-Sonoma reported a gross profit of $864 million for this quarter, which is up from $803 million a year ago. Even better, their gross profit margin grew nicely, reaching 47.1% compared to 44.9% 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 last year. That means for every dollar of sales, they're keeping more money after paying for the cost of the goods themselves. This jump is thanks to better prices on their products and some smart cost saving in their supply chain. Next up is SG&A, or selling general and administrative expenses. Think of this as all the other costs to run the business: marketing, employee salaries, rent for offices, and so on. These expenses went up a bit from $526 million last year to $536 million this year. But here's the interesting part: as a percentage of their sales, these costs actually went down a little from 29.4% to 29.2%. That means they're getting better at managing these costs as their sales increase, which is a good sign of efficiency. When you subtract those SG&A costs from the gross profit, you get operating income. This is the money the company makes from its core business before things like interest and taxes. Williams-Sonoma reported operating income of $30.28 million for the quarter, a solid increase from $277 million a year ago. That's a healthy jump that shows their core business is performing well. And finally, the bottom line, net earnings. After all expenses, including taxes, Williams-Sonoma reported a net earning of $247 million for the quarter. That's a nice bump up from $216 million in the same period last year. Translating that net earning into earnings per share, which is what shareholders really care about, their diluted earnings per share rose to $2, up from $1.67 a year ago. That's a pretty impressive 98% increase. Looking at the bigger picture for the first half of the year, revenue is up to $3.56 billion from $3.44 billion last year. Net earnings are also up slightly, reaching $477 million a year ago. This shows a general upward trend in their performance across the first half of the year. Let's break down how the individual brands performed. Pottery Barn, their biggest brand, saw flat comparable sales growth. This could be concerning for their flagship brand, but the company mentions increased new products and collaborations as drivers. West Elm, on the other hand, showed pretty good growth with comparable brand revenue up 3.3%. They're seeing strength in both furniture and other home goods. The main Williams-Sonoma brand also had a strong quarter, with sales up 5.1%. This was largely driven by their kitchen products like cookware and small appliances. And their Pottery Barn kids and teen brands did even better, with sales growing by 5.53%. It looks like their collaborations and focus on student living, like dorm offerings, are paying off. Now let's talk about the company's financial health. As of August 3rd, 2025, Williams-Sonoma had a very healthy $985 million in cash and cash equivalents. They also have no outstanding borrowings on their main credit line. This strong liquidity position is crucial for weathering economic uncertainty. They've been actively returning value to shareholders. In the first half of the year, they spent nearly $290 million on repurchasing their own stock. They also paid out $156 million in dividends. This shows confidence from management and a commitment to boosting shareholder returns. This phrase here, while about management responsibility, hints at the underlying structure of how they manage their business and capital. They are prioritizing investments and taking on responsibility for their actions and financial decisions. Looking at taxes, there's a mention of the One Big Beautiful Bill Act. This new US law is expected to have a minimal impact on their tax rate, but could actually lead to some favorable cash tax benefits soon due to accelerated deductions they can take. There's a technical note about an immaterial correction to some 2024 financial reports. It seems they didn't quite account for some inventory shrink losses and a related bonus accrual perfectly in earlier reports. They've now corrected these amounts and they state it wasn't material to those earlier periods. But it's good to see them being transparent about even minor adjustments. They also talk about their credit facility. It's a large line of credit, $600 million, that can even go up to $50 million. Importantly, they aren't using it right now, which means they're not borrowing money on this line. They are using it for letters of credit to secure things like insurance for workers' compensation, which is a pretty standard business practice. What's good to see is they're in compliance with all their loan agreements, including a key one about how much debt they can have compared to their earnings. This shows they are managing their debt responsibly. Now, what are the potential hurdles? The company mentions growing uncertainties in the economy. Things like inflation, high interest rates, a shaky housing market, and global instability could really hurt their sales. They're also facing double tariffs on imported goods, which means their costs are going up. They say they can't offset all of these extra costs, which could impact their profits. This is a pretty significant risk they're flagging. This particular phrase snippet points to the broader goal of financial analysis, which is exactly what we do here. It emphasizes understanding the narrative that the financial data tells. Like many retailers, Williams-Sonoma's business is seasonal. They expect to make a lot of their money in the busy holiday season from October through January, and less during the rest of the year. So what's my take on all of this? Williams-Sonoma seems to be navigating a challenging retail environment quite well. Their gross margins are improving, which is a really strong indicator that they're managing costs and pricing effectively. Earnings per share are up, and they've got a healthy amount of cash. The growth in brands like West Elm and Williams-Sonoma is encouraging. However, the increased tariffs and the broader economic slowdown are definitely risks they need to watch closely. If those economic headwinds really pick up, or if they can't manage those tariff costs, it could put a dent in their future performance. For now, though, they seem to be on solid ground. Showing refestively risen brands like West Elm and Williams-Sonoma is encouraging. However, the increased tariffs and the broader economic slowdown are definitely risks they need to watch closely. If those economic headwinds really pick up, or if they can't manage those tariff costs, it could put a dent in their future performance. For now, though, they seem to be on solid ground. Showing resilience and strategic focus. Alright, that's our breakdown of Williams-Sonoma's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.